I think the Fed began its tightening cycle over a year ago. I think it's going to continue on this path of very gradual, very modest tightenings. I'd anticipate that we're going to get one and possibly two more tightenings between now and the end of the year. I think earlier on, you may have thought you'd get four this year. Whether it's four or three, I think is less of importance. I think it's that the direction and trend is still for modestly higher levels of rates. I think they've got a kind of a luxury right now that inflation is not a big issue, so they can afford to go slowly. The economy is not taking off, so they can afford to go slowly. But at the same time, they should use the fact that markets are fairly stable, volatility is very low, to get the base rate up, because ultimately, whether it's a year from now, 2 years from now, we will have a slowdown and they will need the ability to cut rates to stimulate the economy, and you can't stimulate from zero on the rate front. So I think this is a good opportunity. They're taking advantage of it to gradually move rates up. So from a funds perspective, a Fed funds rate perspective, I think we'll see this gradual increase. Now I want to put that in perspective as well. We've had a period of time where if we were talking about 2.5%, funds rate, people would think that's ultra easy monetary policy. We're in an environment now where the talk of going to 2.5% is all of a sudden tight policy. So I think there's a little bit of, I'll call it almost silliness in the focus on the funds rate and the absolute level, because if you can't make your businesses run at a 2.5% rate environment, you can call into question, is that the right business decision being made? So I think the Fed's on a good path here. I think they're going to be very cautious as they move forward with that. The other thing, and I think it's very important on Fed policy that doesn't get talked about enough, Janet Yellen brought it up in her last press conference and the last FOMC meeting, where they're now starting to talk about what do we do with the Fed's balance sheet. As we know, they started the QE program when rates didn't work. They've now blown up the balance sheet to roughly $4.5 trillion. Where do we go from here as it relates to that? Well, I think that's a hugely powerful tool that they have to affect policy. If they began selling all the bonds they bought, that's effectively quantitative tightening. So they have a resource they haven't had before. You also have to be careful with that because we've never had to unwind a balance sheet before, so we don't know what the implications of that are. So I'd focus pretty closely on that. I think the Fed's going to be very cautious because they haven't done it before in how they go about that. The beauty is they can simply let the portfolio roll off over time, and it will very gradually come out versus any sudden large-scale selling programs, which could have a material impact on rates. The other thing, if we go back again to the quantitative easing period, we had Operation Twist, which the markets made a lot out of when the Fed was moving to adjust the shape of the yield curve. Well, they can also use Operation Twist effectively in the unwind if they want to have implications for the yield curve. So I think it's an important tool, and that's one of the things we're looking at when we're looking at Fed policy.
All investments are subject to risk, including the possible loss of the money you invest. For more information about SkyBridge Capital Multi-Advisor Hedge Fund Portfolio Series G, call 1-888-759-2730 to obtain a prospectus. Investment objectives, risks, charges, expenses, and other important information about a fund are contained in the prospectus. Read and consider it carefully before investing. This webcast is for educational purposes only. We recommend that you consult a professional advisor about your individual situation.